Right now, almost 75% of the retail traders are going into a trap. And if you don't want to be one of them, keep watching the video and I'll show you how it's done. Today what we're going to do is, I think the first thing you got to do is, from what I've learned, I think is before you actually start a trade, what you have to do is you have to go for seasonality and COT commitment of traders. That's really, really interesting because that gives you the direction and bias, and then you can come back to technicals where you're going to do supply and demand, where you're going to put your take profits, stop loss, bunch of stuff. So at the end of the day, you got to get a big picture, you know what I mean. So what we're going to do is we're going to go to the trading view and go to the Australian dollar futures, because you can only open COT on futures. So that's something you got to know. That I think explained it in my previous video too. So it's actually loading and it's over here. So we have Australian dollar futures opened right here, and we have COT index. As you could actually see, I'm gonna go to settings. So commercials and retail traders. Commercials actually explain, represent the yellow line, and the pinkish line is representing the retail traders. As you could see, retail traders confidence level is 74%. If you look to the left side, to the right side, you're gonna see right here the this is in terms of percentage. So the retail traders I'm gonna actually say it's a confidence level where how confident are the the people to buy, and as you can see, retail traders are actually 74% confident. So retail traders are actually buying up, and as Bernd Skorupinski says, when retail traders are buying, you gotta be selling. So that's what we're probably gonna do. And as you could see, the commercial traders are like 58%. So that's like it's above 25%, but it's still not as confident. They're not as confident as retail traders are. So now we do know that we have checked the COT index for retail traders and decided that retail traders are trying to buy and buying up the whole thing. We're going to be thinking of selling. Now, there's another thing you have to do, which is seasonality. So we got to check out the seasonality and see if there's a historical rise or drop of Australian dollars against US dollars. So, you could literally actually go and do it manually, but I'm not going to do that. I'm a smart person. I'm going to just, I'm going to actually just, Google it. So I'm going to literally not, I don't even want to type it. I could just, ask from Google. Hello, could you summarize the seasonality going back to 50 years of Australian dollars against USD, if whether there's a drop or rise? Oh, for starting, apparently I'm not as smart as I claim to be. Starting from late July to August, to early August, I'm gonna say, because that's where we are right now. Early August. Yeah, guys, I just got caught. I'm not smart. I got busted. So historic Australian against US dollars tends to show a drop or weakness, marking August as one of the most bearish periods, going back to 50 plus years to the start of modern Forex market in 1971. So historically there's a drop starting from July to early August. So as you could see, now we do know the seasonality is Now we do know that seasonality is in terms of seasonality, the Australian dollars tend to go down during this period. Plus, COT is saying that retail traders are actually trying to buy up, even though the historical pattern is saying, all right, it's gonna go down, guys. So what we have to do is we have to aim, obviously bet against retail traders. So today we're gonna be, looking for a short position. That's what I do, guys. I just literally Google it. You could ask it from AI or a bunch of other stuff. Probably there's probably some apps where you could actually check out the seasonality. I don't know any of those. I don't even want to do it manually. I don't want to go back to 50 years, go through the charts and say, all right, there's a drop. Now what we have is this chart is in terms of weeks. We could literally change it to days and do something about it. And as you could see, what I want to do is I want to explain the thing that Bernd Skorupinski says. When big institutions actually place an order, what they do is they don't actually sell. They don't do like selling positions like 100%. What they do is they sometimes do like a 30% selling orders, and then they wait for the market to come up to the supply zone, and then they do that 70%. So I think we gotta be looking for that. If you guys didn't get what I said, you guys could comment, and then I'll explain, I guess. So we gotta be looking for places. I'm gonna use the horizontal line thing. I'm going to use the horizontal line. I'm going to go to daily chart, and I'm going to be using horizontal line to show you guys what I'm saying. Because at the end of the day, if I don't show you guys what I'm actually saying, it's going to be a stupid idea, and you guys gonna call me stupid, even though I might be stupid. I don't know. We'll see. Yeah, I am stupid. So if you look over here and see my horizontal line, the one that I've just drawn, you're gonna see that starting from there, that's a peak, and then starting from that point, the market was going all the way down, and that's where the next supply zone is. The peak supply zone is gonna be. So as you could see, right after that, you're gonna see these two big red candlesticks. What they do is the big institutions were actually dropping right after that, but I don't think it's 100% drop. They had probably done 30% of their selling positions right after that. That's where our stop loss is going to be, and then we're going to be looking for something. Where do we want to start selling? I'm going to go to the daily one, a weekly chart. I'm going to go to the weekly chart. I'm going to say, as you could see, all right, guys, as you might see, horizontal line. All right, if you guys see, I'm pointing. This is a red candlestick, and then there's a green one. What this means is, as soon as this whole thing dropped, it was obviously big institutions. They sold it, and there was a little bit of a peak. That's a green candlestick, and right after that, there's a drop again, and now it's going up. So this is where this is. I'm gonna put the horizontal line right there. I'm gonna put the horizontal line right there. So right there is going to be where we're gonna, if the price comes to this horizontal line, we're gonna start selling. Why? Because right after that, as you could see, there was a drop. That's where the big institutions want to start selling. That's good enough for them to start selling. So I'm gonna do a short. I don't know if I'm actually explaining it ideally, but I'm gonna put it a little bit above it. I'm gonna do something like this, short position, and then I'm gonna, as we could see, the highest horizontal line. Then we're gonna see. So did you guys get the idea what I'm talking about? Or I will try to explain one more time, even though I'm not real good at it. Because if you actually get the whole concept, you gotta be able to explain it to a 5-year-old kid. I'm not saying you guys are a child. Most of you probably are grown-up people. Because at the end of the day, I think that, I think kids won't be, bothered to learn trading yet. So as you could see, what I'm trying to say is that, right, I'm actually using this. I'm actually using this this green candlestick to mark up where the market is, where the market supply zone is, because right after that green line, green candlestick, the big institutional sellers start dropping, start selling, and that means that actually points out where they are willing to buy, where they're willing to sell next time. So that's where you want to, when the price comes to that point, they're again ready to sell up their 70% of the trade. Now we do know where the starting point is, and we do know the stop losses, and I'm gonna explain my reasoning behind stop loss. Now I'm actually placing this thing, assuming that this is gonna go all the way down and making me a lot of money. But if it doesn't, I'm gonna be ready to put a stop loss somewhere. And where is that gonna be? It's gonna be, as you could see, the highest horizontal line over here. The one over here, I just placed it here, is going to be my, I'll put it a little bit above that. That's where my stop loss is going to be. Why? Because as you could see, that's the peak point, the supply point. Assuming that buyers are not going to cross it. If they do push through this horizontal line, then this whole trading idea is gone. So I chose this highest peak point of this trend, and assuming this is going to be the stop loss. And now, where is going to be my take profit? For that, I have to go to the weekly chart. My take profit is obviously going to be the next demand zone. Where is the next demand zone? Next demand zone is going to be over here. I'm going to use another horizontal line and say, all right, this is going to be, all right, this one is going to be the next demand zone. This one is going to be right here, right here. This is going to be the next demand zone. I'm going to place it a little bit above that. Oh, that's perfect. That's too perfect. That's too motherfucker. No, I'm not going to swear. So, yeah, this is where my take profit is going to be, and I'm going to explain why that is. Because imagine the price hits my horizontal line right here, and then I start my selling position. Once I start my selling position, I have to look for a place where I want to sell. And this is exactly where I want to sell it. If that does make sense. Where do you want to sell it? You want to sell it where there are people who actually want to buy it, and that's going to be the next demand zone, and it's right here. So, and I hope this video does make sense for you guys. If it doesn't, just comment. And I hope you guys can be polite. If not, it's fine, because I'm a learner, And I will see you guys later. Thank you.